Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This show is brought to you by CREISummit.com. Check it out. September 11th through September 13th, commercial real estate influencers. And if you have anything to do with commercial real estate, social media, podcasts, shows like this, LinkedIn, just anything to do with real estate, you want to check it out. It's a fun group, a lot of great speakers, and I can give you a discount code to get 10% off. It is Michael Bull 10. There you go. So visit CREISummit.com. Well, today we're going to talk about the commercial real estate market, right? What else? Well, and here we are at the middle of the year. So what should we talk about? How about the U.S. Deals 2024 Midyear Report from PwC? Please welcome my guest is Tim Bodner, and Tim is partner with PwC. Tim, good to see you.
Good to see you, Michael. Thanks for having us.
Well, I always appreciate and enjoy the reports and things you guys do and having you on the show. And, you know, one of the things that seems to be on the minds of a lot of people in commercial real estate right now is the capital markets, right? The financing and the creative financing and the private equity. You know, what do you guys see now and moving forward as we look here at midyear 2024?
Yeah, I think when you think about the capital markets, Michael, as it relates to commercial real estate, there's a couple of headline messages to focus on. Number one is the level of distress is not anywhere near where I think a lot of people thought they would be at this point in time. And in fact, according to a number of the numbers that we look at, distressed sales activity was 3.9% in the first quarter of 2024, which is, up from around 2% where it has been for the last several quarters. And that's largely due to a large retail deal that got done. And if you look back over history, in particular back to the financial crisis, at its peak, distressed sales activity was about 20% of transaction volume during the financial crisis. So we are far away from where distressed activity has been. And so we continue to believe that this time is different. And as you highlighted in your remarks, we think the market is being quite creative around how some of these situations are being resolved. The second point to comment on is that modifications and extensions are, a significant part of the story. In fact, the vast majority of maturities in 2023 were pushed out to this calendar year, and the amount of loans maturing in 2024 are substantially higher than they were if you look back at the numbers in January of 23. So, the lenders and the market are working together to try to resolve some of these situations into a period of time where the markets are more accommodative to a refinancing transaction getting done. And the third and final point to highlight is we continue to believe that private capital is going to play a more significant role in the real estate finance markets as the traditional financial institutions pull back. And even though CMBS market has become more active, if you look at its proportion relative to the last 10 years, it's a much smaller piece of the puzzle. And we think private capital will help fill the void, and in particular capital provided by insurance companies, either directly or through alternative asset managers that have been for a period of time acquiring either insurance companies directly or managing investment portfolios on behalf of insurance companies.
Well, Tim, let me ask you this. If some of these lenders are kind of kicking the can down the road, if you will, on maturities and workouts, pushing the 2023 deals to 2024 and maybe beyond into 2025, you said we're at 3.9% distressed sales, and at the peak in the great financial, we were at 20%. Do you think we go up from here? I mean, it seems like the headlines are there's going to be a lot of distress. And we're not seeing a lot of it. We are seeing a good bit, but not as much as we did last time. What do you expect moving forward?
Yeah, I think the reality is, of course, like we're going to continue to see distress transactions occur, particularly in the office sector. But there are, issues that continue being encountered in retail. There's some around hospitality and in certain places like San Francisco and others around the U.S. and the world, for that matter, that will need to get worked out in some way or shape or form. So we are by no means saying that we won't see distress and we won't see distress move higher from here. It's just on balance, we think the distress is going to be much less than it has been in the past for a whole variety of reasons. Most significantly, that I think market participants acknowledge that what occurred during the great financial crisis was not what they want to see happen again, and they're not set up operationally to deal with that. And so if there's a way to push things out and let the market kind of correct itself from a macro perspective, then that's the preferred alternative.
Yeah, well, it makes a lot of sense. And I'm seeing some of these banks and lenders selling notes at a discount and really taking way bigger losses than I think they should, than they could have done maybe with a short sale, letting the sellers sell it or just foreclosing, unfortunately, and or deed in lieu and selling these sales. So interesting to see. Do you see on your mid-year report, you guys look at it, how are investors adding value? What are they doing to what levers can they pull if the bank financing is not what they'd like to see?
Yeah, it's a very broad question, and we see it being expressed in a number of different ways. I think one way to think about this is if you look at things from a sponsor perspective or a management company level, there's significant focus on the go forward operating model of how real estate investment management businesses run themselves in this new environment where things are just structurally different. We are going to have higher rates for a longer period of time. We are going through a period of higher prices, even though inflation is coming down. If you just look at it over period of time, pick a year, prices are higher, and so affordability is an issue for many people in the United States and around the world. And so the environment's just different. You also have what's going on geopolitically, and there's a significant number of elections around the world this year, and obviously here in the United States. And so how companies run a business in that type of environment is very different than what it was when interest rates were near zero. We didn't have as many issues around affordability. So it's everything from, do I have the right skills to operate in this environment? Do I have the right technology solutions? How do I think about AI? Do I organizationally have people in the right spots and cities? Am I in the right products? Am I in the right geographies? And so at a manager and sponsor level, there's a significant focus on resetting the strategy around how their businesses will be run going forward. And we don't see any sign of that slowing down. In addition to that, at an asset level, there's a lot more focus as part of diligence processes and otherwise around what the levers of return generation are. And it gets into everything from more sophisticated strategies around the setting of rent prices. How do you think about pass-through costs to tenants? Are you in the right geographies when you think about the significant increase in climate-related events around the U.S. and the world, for that matter? How people are underwriting CapEx and choosing to invest in certain markets is all coming to the fore, and we think that's only going to accelerate and be a greater emphasis for investors moving forward.
Yeah, and some of these folks are getting creative, right? We've been doing a lot of owner financed transactions. Are you seeing more of that?
We certainly are. I mean, just across the board at this time, there's people are getting much more creative around how to finance deals. So seller financing is becoming a significant part of the equation. Joint ventures and partnerships are a significant part of the equation. Private placements are part of the equation. Leveraging the retail channel and high net worth individuals are part. So I think just the overall topic of people, as we were talking about before the show, this is not the first time people have navigated periods of volatility like this. And so the creativity of the real estate industry is coming to the fore like we haven't seen it in some time. And we think that's going to continue.
Yeah. That's a good point. That's, I've been through some recessions in my career, and that's when you learn to really get creative, right? It can really make you better at what you do when you go through some of these tough times. And another form of investment we're seeing these days in commercial real estate is in infrastructure. How does that work? Tell us about that. Mm-hmm.
Yeah, so this is one of the things that is incredibly fascinating to us, and it's not entirely clear how it all plays out over time. But there certainly is a widening of what is considered to be investable real estate assets, and it's certainly evolving from what is commonly described as real estate, which is office, industrial, retail, multifamily, hospitality, et cetera, to something that, according to, some ways we've heard it described as kind of 25 or 26 different alternative asset classes, and even things that were once considered to be niche. So if you look at something like student housing, senior housing, and the like, those are actually, in many respects, mainstream asset classes at this stage that in some cases have very large public companies, and in other cases had large public companies, but have been taken private over the last 5 to 7 years. So that would even, when we talk about kind of a widening, we're even going beyond that into, certainly data centers is what gets talked about the most, but it's broader than even that into things around mixed use developments around entertainment districts, wellness related real estate, where we've seen a number of deals come up and with respect to golf courses and marinas. Again, just given the continued propensity of people to spend on experiences, and going into even further than that into things around what's happening with the resiliency of supply chains and the amount of investment that's going into semiconductor and other manufacturing facilities that are tied to some of the stimulus programs put in by the government around the Inflation Reduction Act and the like. And so according to one measure that we saw the other day, there's roughly $206 billion of announced manufacturing investments in the United States, the vast majority of which are in clean tech and are in markets that, were once hot, but some that, were not even on the radar screen and now are. I heard one head of strategy for one of the large public REITs describe it as that Ohio is the top, Columbus, Ohio is the top market on his screen right now because of the manufacturing investment going into that area of the country. And so certainly the facility itself is an infrastructure-like investment. But what we're seeing excite a lot of traditional real estate market participants, as well as the real estate development opportunities that are around it or adjacent to those manufacturing facilities, because of the growth in employment that's expected to be seen based on that number I told you of 206,000. I heard or saw one analysis say there's going to be 195,000 new jobs created just through those announced programs. And when you think about what's happening with the energy transition and the like, there's a lot more investment that's going to be coming behind that.
Yeah. Well, that's good news. And You mentioned earlier, elections around the world, and we have the one here in the U.S., right, for our president. Does it really matter to commercial real estate and the economy? I guess the economy affects commercial real estate, right? But does it really matter for commercial real estate, the results of an election like that?
We haven't seen in the past elections have a significant impact on the real estate finance markets. I think the thing that we are focused on the most is what impact does it have on confidence with increased uncertainty. And as you know, as a practitioner in the industry for a long time, particularly in the deal space, uncertainty and lack of confidence impacts people's convictions around deployment of capital and the pace of that deployment. So that is what we pay most attention to, is what is it doing to people's confidence in running their businesses in a period where we could have elevated uncertainty, whichever way the election ends up going, which we'll certainly find out in the next couple of months.
Yeah. Well, I'm hearing Biden has on his plan again to limit the 1031 severely to, I think, $1 million or something. And if that's part of his tax plan, I mean, I guess that gets, we keep hearing that a lot year after year. And then they realize, well, it's been there for 100 years. There's a reason it really helps economy, businesses, and jobs. But do you have any thoughts on the impact of a limitation like that on 1031, what that could do to the commercial real estate market?
Yeah. Well, I think the point you're highlighting, Michael, is that we see that every time it comes up for renewal, as there's also the ending of the 2017 tax cuts that are coming up. And I think one of the significant concerns of many industry participants is how some of those things get resolved, including the 1031 program. So I think it's going to be another case where the industry will lean into educating members of Congress on the importance of it to the lifeblood of certain markets in certain communities in certain parts of the country, and that we think will continue to be the case in this instance, and 1031 will for sure be part of that.
What do you think on the mid-year report here, Tim, moving forward for inflation and jobs and potential impact on rates?
Yeah. So look, I think the thing that is should be top of mind is inflation is coming down. It's coming down around the world. We've already seen in certain places internationally, like Switzerland and Europe, with the ECB making downward adjustments to rates. And at some point, that will happen here in the U.S., whether it's 0 adjustments this year and 2 next year or whatever. I think the data will drive that conversation. But the real topic is that there is an affordability issue that a lot of people are focused on, which is just the notion that prices are just substantively higher than they have been. And so that issue is going to be with us for some period of time, and will have impacts on certain segments of the economy in terms of how much people spend. I was looking at an analysis just before our discussion today around people's desire to travel this summer, and what you see in the data is a bifurcation according to income. And so certainly we're already seeing having an impact on parts of the economy.
Yeah. Well, Tim, it seems like when I look back at my career, and I'm still in it, so I guess I can still, I don't have to look back, I'm still in it. I saw the SNL crisis and the groups that bought apartments and other things, especially multifamily, which was I was in at the time, just made a killing. And then I look at the great financial recession, and homes went bust, and everybody said homes would have no value. And groups that bought those homes and rental homes and individuals buying their own homes have done extremely well. We've had the same thing a couple times, it seems like, with retail, where retail was left for dead, and then retail kind of bounced back and is, for the most part, it's doing it really well. Well, now we have office who everybody's leaving for dead. We're seeing some pretty crazy prices. We sell all over the country, but mainly in the Southeast and around Atlanta. And we just closed one for $360 a square foot Friday. We have another one about to close, though, that's only $57 a foot. So, is this potential opportunity for some of these groups to look at the timing of all this?
Yeah, I look, they're like, other cycles. There will be opportunities to take advantage of the correction in prices. The point, though, is patience is really what is going to be of most import in this environment, because it's not happening with the pace that people, I think, anticipated. So for sure, there'll be significant opportunistic opportunities to capitalize on the pricing adjustments that are going to happen, but it's going to require patience, creativity, and a focus on specific markets and sub-markets where prices have diverged from underlying value more significantly than others.
Yeah, that's a good point. And it seems like today more than ever, real estate is really asset per asset. You need to really look at every detail and not just kind of broad brush cap rates or the market, right?
Yeah, and that's we've, in prior editions of our Outlook, we've focused on that, and we've covered it, I think, in prior discussions on your show. And that really is that real estate is not one thing, and each asset needs to be looked at in the appropriate context, and not all sectors are not created equal. So that kind of lens is so critical to be able to look through in one, making an accurate assessment of where the market really is, and also thinking about how to deploy capital in a way that generates the most accretive returns.
Yeah. Tim, what do you see in here as far as the banks moving forward? I mean, we've had a few bank failures, but what do you expect there?
Yeah, look, 70% of the commercial real estate loans are in the regional banking system. When you just look at, the underlying data, when you look at, the regional banking system, there's probably about 10 to 12 regional banks that have, loans as a percentage of capital that are, significantly in excess of where I think folks would like them to be. So there certainly is pockets of the system that that need to be watched carefully, particularly in the regional banking infrastructure. But when you look at it, the charge-off rates have not materially picked up on those loan books. The delinquency rates have not materially picked up. They are higher. For sure. So there is there is attention that needs to be placed for sure on the regional banking infrastructure, but it's banks below $100 billion in assets. When you look at the banks above $100 billion in assets, their commercial real estate loans as a percentage of their total loan book, or even their risk-based capital, is quite low. I saw one analysis that put it at below 20%. So the financial institutions that are above our $100 billion, has been said in the discussion surrounding Basel III, are quite well capitalized. There's some situations in the banks below $100 billion that would be regional banks that are ones we need to watch, and may result in a merger happening, or another acquisition, or perhaps a regulatory action, depending upon how the book unfolds.
Well, it sure seems like a good time for lenders to really do some good, safe loans. Borrowers getting in a lower basis, higher down payments, bigger debt coverage ratios, and some quality properties, right? So I think it's a good time to build relationships if you're a lender. One of the opportunities I also see out in the market right now for our listeners and viewers is if you're a company that uses office space, by all means, maybe you should consider buying it. It's a incredible time for that.
It's interesting, Michael, that you make that point, because the other thing that we have seen begin to pick up that we covered at a high level in the outlook is we have seen non-traditional owners of real estate making real estate purchases, and one specific segment of the or sector that's done it is in the consumer market space and the luxury retailers. If you look at certain major markets around the world like New York and London, if you look outside of the U.S., we have seen owners, non-traditional owners, choose to make real estate purchases, and it's broader than that. We've also seen a number of businesses in the health services segment, and the technology, media, and communications segment, other parts of the consumer space, choose to actually use real estate as a driver of value creation inside their non-real estate business, because of kind of the point you made earlier, which is that this is viewed as a way to get in at a very low basis and generate value over time. So I think it's a great point, and there are a number of things that we've seen happen in the markets that are in complete alignment with that, and we think it will continue. So I think it's a great point for non-traditional real estate investors to kind of think about how the real estate fits inside of their overall operating business strategy.
Yeah, I think it's going to be real interesting. Some of these companies and investors getting these office buildings at sometimes 25% or 10% of replacement cost, and with the cost to replace these. I got a quote the other day on a building, and I asked, well, what do you put in there for annual escalation? And I said, oh, that's come down. It's only 6%. So I'm like, all right, so these buildings are going to cost 6% or more a year. There's probably going to be more. Some of these buildings are going to get torn down, some converted to other uses, especially as more tax incentives and credits show up, right? And then, there's not going to be not much new supply except for ultra, Class A, which isn't having a problem. So I think it's going to be interesting to see, especially the markets like the Southeast and Sun Belt, where, we're continuing to have a population growth and businesses coming. I think a lot of these companies are just going to really have a windfall, and I think it might even happen faster than we all think.
Yeah, look, I think the conversion process that's available around some of these assets is a topic where it comes down to the other economics of each particular deal, and in many cases, those economics prove to be challenging. But as you just articulated, and we've seen some of this outside of the U.S. I had my colleague Braden on your show the other week talking about what's happening in Canada, for example. And in Canada, in certain markets, the government incentives around building conversions are becoming quite significant, and we've seen signs that some of that's going to move here to the U.S. And in addition to that, there's the governments themselves that are looking at their real estate footprints. And we've heard and seen here in D.C., where I live, for example, a number of really attractive assets that are going to come to market because the government is readjusting its footprint. So the government, kind of the stimulus around conversions and just investment opportunities, is another area to watch. For sure, as you articulated.
Yeah. And to the point earlier that we were talking about each individual asset and property type, the headlines, real estate's bad, or the headlines, office is bad. But, we sell government leased office buildings, and, they're very strong and sticky, and, they're going to pay the rent because they're just going to get the money from you and me, and they're going to pay, right? We've got a 9-cap deal that's 82% occupied by a very strong government tenant, and then the medical bill, it's just really selling well, right?
For sure. I think it just comes down to, the point that you focused on at the onset of that comment, which is that there are many attractive opportunities in the market right now, but it requires looking at each opportunity for what it individually presents itself, and not looking at it as, if it's an office building in Atlanta, then it's like every other office building in Atlanta, right? Or whatever city you may choose to focus on, which is, so it really is asset specific, asset class specific, geography specific, and there are many opportunities to capitalize on that.
Yeah, good point. Well, here we are. It's about to be July 2024. What would you leave our audience with, Tim, to think about on your mid-year report?
Yeah, we continue to bet on the industry to work through the challenges. We think there's alignment of interests among market participants to work through the challenges that we have. And there's also, very exciting new and emerging opportunities that haven't been part of the equation historically that are now present. So we're betting on the market, and think it's going to be an exciting time for real estate and infrastructure to move into something called a real asset type investment strategy that we think is going to be exciting.
Good. Well, now I'm more excited too. Thank you, sir.
Great to see you, Michael. Thanks for having us.
All right. Thank you. And thank you for joining us around the country. Please let us know what you think. Hey, please share the show if you will. And if you will, connect with us on your favorite social media. If you need me or have a question for me, reach out to me anytime. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by CCIM C5 Summit. We'll be at the Hard Rock Hotel in Hollywood, Florida, September 17th to 19th. Visit c5summit.realestate. By CREI Summit. This will be in Atlanta, Georgia, September 11th to the 13th, right here in Atlanta, Georgia, where we're headquartered. Visit cresummit.com. By Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creShow.com.